Good morning and welcome everyone for Income Tax Return and Best Preparation Skills Workshop. Topic 3, we're going to talk about today capital gain tax. So, capital gain and capital gain tax, it's two different terminology. We use that in our tax area. The difference between capital gain and capital gain tax, nothing. So capital gain, so when you're buying and selling a capital assets, if you make it any gain from that, it's mean in your accounting terminology, if you make it any profit, you're going to pay the tax on that. So there's no any separate tax calculation or tax rate for the capital gain. We calculate the gain, how much the profit in your accounting terminology, or how much that gain you're making from that capital transaction. You're going to add that amount with your other assessable income. You have salary, investment income, business income, government benefits, all of the foreign income. So same as this also kind of income. There's no different tax rate for the capital gain. So whatever gain you make it, whatever profit you make it from your capital transaction, you're going to add within your other assessable income, same as foreign income, same as rental property income, same as business income. So therefore, one important, there's no any separate tax table or tax rate for the capital gain. But there are rules how to calculate a capital gain. So I'm just start with that your normal accounting terminology. Capital gain equal to what is the sales income? You sell it some capital property, right? Minus your purchase cost, right? That's in our normal accounting terminology. You purchase a investment property and for $500,000 and you sold it now for 700,000. So your gain will be 700 minus 500, which is 200,000. That 200,000 you should add with your assessable income, right? That's called capital gain. Now we will come back. Actually, in our tax terminology, we normally not use sales income. We use this terminology called capital proceeds, right? The amount the received by taxpayer for the disposal of the assets. So it's mean whatever amount you received in your bank account or you are entitled to receive in your bank account, that going to be considered as a capital proceeds, right? We normally not use the terminology of sales income in the capital gain area in our tax calculation. Then we will go the cost base. Instead of purchase cost, we introduce a new terminology called cost base. What does the cost base mean? That your purchase price and any other cost associated with the particular capital assets, which is allowed by legislation to deduct as a cost base. So we will go and talk a little later what are the item included in the cost base. So what we learn here, two terminology. Capital proceeds, that's the amount you receive from your sales. Capital cost base, any cost associated with that particular assets. We will build it a little bit more down the track. So there's example here. You can say taxpayer acquired shares for $10,000 and he sold it for $20,000 in a different date. So how much a capital gain? So how much money he received? 20,000. So capital proceed 20,000. How much is cost here? 20,000, $10,000. So 20,000 minus 10,000. So his capital gain going to be $10,000. Now important question, how we going to treat this one in our capital XPM. So I'm sharing the XPM with you guys in a second, and I will go to that capital gain and give me a 2 second. I will just delete this section. So everyone know we normally use the Steve Smith. So if you go to the income in your section 18, you can see capital gain. So this is the summary of the capital gain. So you no need to enter anything here. Normally what we do, we are going to enter this one from in our worksheet, not the schedule. You can do through the schedule as well, but do through the worksheet. So every single capital gain transaction your client have, you can have a separate worksheet. You no need to do anything. You enter all the information in each worksheet. It will be summarized and move into that in your income section 18 automatically. All right. So you may have, client have 10 different shares trading. He may have 2 investment property, and he may have collectible, personal assets, whatever. You're going to enter that one here, and your worksheet, it will be summarized and move into in that capital gain area. Now we will come back here and talk about this one. So what is the example we have? Shares. So Australian listed shares, you enter the description by which company or whatever. What the date you purchase here? They say first of July 2015 the purchase, and 30th of September 2019 you sold it. Excellent. And at this point, you click other. I will explain to you what is the difference between discount and indexation later. Capital proceeds, the same terminology what we learned. So how much money you received? $20,000. Assume that you have the full ownership of that. So how much the cost? You can say then total cost. That's called cost base. How much it is here? $10,000 he purchased that one. So 10,000. You can see $10,000 capital gain. This 10,000 will be moved into in our income section automatically. If you go down in your section 18, you can see the 10,000 here. So this is the way we're going to handle in our capital gain in XPM. Again, I will come back to this XPM little later, but at this point, I'm going back to that in our um, PowerPoint. So here it is. So category of assets. So for the different rule will applies for different type of assets. So capital gain, we have 3 different type of assets. Assets which is normally we call land and building and investment property and residential property and shares going to come as a one category. That's called normal assets category. Other 2 different category of assets, collectables and personal assets. What does the collectible mean? The people collecting some item and keeping with them and sell it down the track, like a jewelry, diamond, stamp, painting, drawing, coins, notes. This type of item, they collectible. They just buy it and keep it and a period of time, and they maybe sell it in the future. All right. Second one, personal use assets. The asset which is normally used in your day-to-day living, your furnitures, your electrical appliance, in your household items, everything come under personal assets. You may be not happy with that here. We are talking about the personal assets also come under capital gain. For an example, you have a dining table you purchased for $12,000 a couple of years back. Now you are selling for $15,000. You required to pay the capital gain on personal use assets, right? Even though that's for your personal purpose, if you're making capital gain, you're required to pay the tax. So collectible. So you purchase a little diamond necklace and keep it that one for a period of time. You think that's a very antique type and you sold it now, that may become under collectible. So anything under collectible or personal use assets, it goes under other assets or assets, right? So we have 3 different type of capital gain assets. They have 3 different rules for each ones. So we're going to talk about that one, each different type of assets, how will that work, right? Right. Some of the assets we no need to pay that capital gain tax. It means we no need to pay, calculate the capital gain, some the type of assets. It means they are exempted from CGT event. CGT mean capital gain tax. What type of assets or what type of circumstances we will see one by one. Any assets acquired before 20th of September 1985, you no need to calculate the capital gain. Huh? So asset purchase before 20th of September 1985 not come under the capital gain system. Why it is that capital gain tax introduced 20th of September 1985. That's the reason if you purchase the asset before that, you no need to include in your capital gain calculation. Second one, the main house where you are living, what is where's your ordinary meaning of the word, where you are living in that house will be, when you sell it, you no need to pay the capital gain tax. Right? That not only the house with the 2 hectares land, adjoined land, right? Not the other land a little bit further, the land including house. So normally maximum area is a 2 acres adjoined land. Other one, betting and gambling wins, as we discussed last week. There's no need to pay that capital gain or any other tax unless you are doing as a uh, employment. Any personal use asset less than $10,000, we no need to pay the capital gain. So what's the meaning? So if you have a you purchase a dining table for $8,000 and now you are selling for $12,000, we no need to include in the capital gain. The reason is the rule for the personal use assets. Any assets less than $10,000, you no need to include in the capital gain. The same rule applicable to collectible. If you purchase anything less than $500, for example, you purchase a drawing for $400. Now you are selling that one after 20 years for $40,000. No need to pay the capital gain because your purchase price is less than $500. Right? So the collectible less than $500 if you purchase, not the sales price, right? The purchase price. If you purchase any collectible less than $500, you no need to calculate the capital gain. If your personal assets purchase less than $10,000, you no need to pay the capital gain. You no need to calculate the capital gain. However, other assets, even though you purchase $1, you're required to pay the capital gain. So these two rules only applicable to personal use assets and collectibles. But other assets, if you purchase $10 selling for $20,000, still you want to calculate. All right. So when come to the personal use assets, the purchase price, not the sales price, less than $10,000, we no need to include in the capital gain. The collectible less than $500, we no need to include in our capital gain. But other assets like a land and building and shares and investment property and everything, we no matter what the price you purchase, you must include, right? Exemption only applicable to personal use assets and collectible. Trading stock, we will talk, I think, down the track. It's in your inventory item in your business. When that value of the inventory item change or going up or down, sometime when we do through that in our stock valuation, it's not going to be included in our capital gain calculation. It will be included in your business income. We will talk the trading stock topic down the track. All right. Compensation for damages or injury, as we discussed last week, anything that if they're paying for the damage for injury or uh, damages not included as a capital gain. Motor vehicle less than 9 passengers or fewer than 1 ton, right? So going to be considered as a motor vehicle. In your personal motor car, when you're using, if you satisfy this rule, less than 9 passenger or less than 1 ton, that going to be considered as a motor car. You no need to calculate the capital gain. However, this one is only for your personal use assets. When you're doing that uh, in the business car or business equipments, we do that in as normal, like calculate that capital loss or capital proceed that proceed, you're going to include as a business income. The motor car and motor vehicle we are talking here exempted only for personal use, right, in your private car. But the business car, what we normally do, we do that in your disposal of capital assets, and you calculate that your gain or loss, you adjust in your account in your P&L. Same way we are doing in the tax return under the business, right? The business income and deductions. So we will talk that one down the track, disposal of capital assets, right? This motor car I'm talking about, that personal motor car using for your personal purpose, right? Here's the example. Albert acquired a partial shares in 17th of October 1980, $10,000, and he sold it now for $20,000. How much the capital gain? Capital gain going to be a zero. Why it is? That's purchased before 20th of September 1985. That pre that capital gain assets. Therefore, we no need to include this one in our capital gain calculation. Right. Good. We will move into the next one. Capital gain. Example, you can see here, taxpayer acquired a shares for $10,000 and 1st of July 2017, that's the date, and he sold it for 20,000 30th of September 2018. The taxpayer incurred broker fees and shares $80, right? Another $60 for selling shares. So now when we calculate the capital gain, how we going to calculate? Step number one, how much in our capital proceeds? Capital proceeds $20,000. How much in our cost base? $10,000 plus $80 and another $60. So how we going to do this one in our XPM? There are two ways. Sometimes this selling fees you can reduce from your capital proceeds as well, but either way it's going to be a same outcome. So I will go to that XPM and explain to you how we're going to do this one. So we will see what are the shares. Yes, $10,000. So I'll go to that capital worksheet, 10,000. Now we have some more expenses. So what we're going to do, we're going to add some more lines. So how much that one? $80 shares. So $80 your broker fees and other one $60 selling fees. So now your total cost will be 10,140. Sometime some softwares we do this $60, we take it out from here, capital proceed. But end of the day, it's same. So 10,140 your cost base. So now your capital gain will be 9,860. So we'll go back to that in our original screen and see that this answer is right. Capital proceed $20,000, cost base 10,080 plus 60, 10,140, and capital gain will be 9,860. Right, so that's the one in our total capital gain. What we get it from in that XPM. Right. So what is very important here? You see we are going to accommodate or you are going to include the selling commission or that selling fees of $60, so that when you are doing this especially that building or land or that investment property sales, the selling commission is one of the significant expenses. Sometime we missing that calculation. That should be included in that calculation, right? Now we'll move into that other one. Very important. The Romeo gave gift to Juliet, an investment residential house valued at $200,000 for no cost. In 2019, Juliet sold investment property for 500,000. But saying here, assume that you are going to do that uh, tax return for Juliet. Who is Juliet? Who received the gift from Romeo. So how much that Juliet's cost base? How much she paid? She did not pay anything. So it's mean that her purchase cost will be zero. How much is selling? 500,000. So when we calculate that in our capital gain, what we going to do? We going to, even though Juliet did not pay any cents for this transaction, we're going to value the assets, the date of the gift, what is the market value of the assets. In this example, what is the market value of the assets, the date of the gift, to 200,000. So Juliet capital gain will be 500,000 capital proceeds and 200,000 her cost base or deemed cost base. That's the terminology we use. So because he really did not pay anything, but the values he received 200,000. That's the reason we use the name deemed cost base, right? So 500 minus 200, which is $300,000 should be included as a capital gain, not 500, right? But now if you're doing the tax return for Romeo, is a her what is it? Assume that her sales price, how much? Her sales price will be 200. The date of the gift, what is the price? Even though she not receive the income, going to be considered as a sales price. Assume that Romeo purchased this asset couple of years back for 150,000. If you're going to do that tax return for Romeo, the Romeo's capital gain will be 200,000 minus her purchase price 150, 50,000. So that 50,000 going to be included as a capital gain for the Romeo. So the Juliet, even though Juliet did not pay any money for that purchase, the date when the property transferred to her, that date, what is the market value, valuation, you can get it from the valuer, and what is the market value of the property going to be considered as a cost base, or we use the terminology deem cost base. The same time, Romeo is not receive any income. However, when we do the tax return for Romeo, we going to do that as a date of gift. What is the market value? That's the sales price. So there are two tax return here, one for Juliet, one for Romeo. So what the important part we want to understand here, the date, the gift, what is the market value, we're going to consider it as a capital proceeds for the Romeo and cost base for the Juliet. All right, thank you. Now we are going to talk about the capital loss, right? So I'm starting with an example. For example, your client working as an accountant, his income $150,000 per year, right? Accountant income, employment income. This year, he did little share transactions, buying and selling the shares, and he make it $10,000 uh, income from capital gain, right? How much the total gain he make it from shares? 10,000. How much is employment income? 150,000. So from the shares, his capital gain, it's been buying and selling the net profit, in your accounting terminology, 10,000. So how much is assessable income now? 150 from that is employment, 10,000 from the shares, total assessable income 160,000. He want to pay the tax on 160,000. That's the one we talk up to now, right? Now we change a little bit. Your client working as an accountant for 150,000 is salary and wages or whatever, right? Now he did that this old share rating this year. It's not worked very well, his strategies with the COVID, and he lost that $10,000 from the share rating. That loss we call capital loss, right? Because he not make the gain, he lost it. So I'm going to show example. You can see cost base minus capital proceed. That's one in your capital loss. So here's the example. So taxpayer acquired a $10,000 and he sold the shares for 5,000. So how much that loss? So 10,000 cost base, 5,000 the money only you received, 5,000 loss. This is the capital loss. So now I come back to that our original example. Your accountant, $150,000 his salary. Assume that, all right, I am happy to go with that same example here. So his share loss this year, $5,000. So now question is, can he take it out this 5,000 from his accountant or employment income and say my income, assessable income now 145? Can we say that accountant? Can we calculate the accountant's taxable income or assessable income like that? No, we cannot. When you make it capital gain, we are going to add with the other income. When you make it capital loss, you cannot reduce your assessable income. You cannot deduct from your income tax. Only thing, you can offset that loss with other capital gain income, right? You cannot offset from other income, right? Like a employment income or business income or investment income or government benefit. You are getting a different source of income, but you cannot offset your capital loss from that other incomes, right? Therefore, he's going to pay the tax on the $150,000. This $5,000 he's showing as a capital loss. He want to offset again other capital gain, or he can carry forward to the future year. If we make it gain from the capital gain, any capital assets, he can offset, right? So that's called capital loss. So I will explain one by one, but we talk. If you make it capital loss, you cannot claim from as a deduction, right? That's capital loss. Deduction cannot be claimed for capital losses. And the capital loss cannot be used, reduce the type of assessable income and other than another capital gain. So what is that word? The capital loss cannot be used to reduce other types of assessable income. That's the one we talk. You cannot deduct that from your salary. You cannot deduct that from other business income. You cannot take it out from your other investment income. Only you can offset again other capital gain. So now we will see this year you are selling two investment property. One investment property, your capital gain $200,000. Other investment property, your capital loss $50,000, right? So how much the loss from the second property? 50,000. The first property, how much gain? 200,000. So this 50,000 capital loss, you can offset again your 200,000 capital gain. In that case, your capital gain now $150,000. Everybody clear now? So what we are doing, if you make it capital loss, you can offset again other capital gain what you are making. There are some rules for the collectible and personal assets. I will cover in a couple of lines later. At this point, what you are thinking, if you make it capital loss, you can offset against other capital income, right? So you can offset again other capital assets gain. So we will see this year you sold only one capital assets and make it $50,000 loss. So in our capital loss this year, 50,000, you have no any other capital sales this year. You cannot offset. So what we can do, we can carry forward to next financial year or next tax year. So next tax year, this will be so in your tax return as a carry forward tax loss from previous year $50,000. Assume that next year you sold that a property, you make it $150,000 gain next year. So now what we're going to do next year, we are going to settle it and say in our capital gain, 150 capital gain minus tax loss 50,000. So capital gain will be 100,000 only. This is the way we're going to offset. If you not sell it next year, you're going to carry forward until you get some gain from your asset purchase and sales or in your capital gain, right? That's called carry forward for the future years until you offset again other capital gain item. All right. So we will move into the next one. If the carry forward to the future income years, there's a no limit how long you can carry forward, right? You can carry forward until that TFN exists. The capital loss relating to the collectible, only you can offset against the collectible. You remember we talk about the three type of assets: collectible, personal use assets, and other assets, right? For the collectible, only you can offset against collectible. What's the meaning? For example, this year you are selling the shares and your capital gain $10,000 from capital gain shares, right? Shares is the other asset group. How much the capital gain? $10,000. Second part, you have some jewelry, right? So you make it the loss from the jewelry for $2,000, right? You purchase and sold it for loss $2,000. So from the shares 10,000, from the that plus it's mean capital gain. From the collectible you lost that 2,000, capital loss 2,000. But even though this is capital gain and loss, you cannot offset that $2,000 collectible with the capital gain you gain from that shares, because collectible only can offset again collectible. You cannot offset the gain other asset group, right? That's called the collectible only can offset against capital gain arising from other collectible, right? Not from other asset group, right? He cannot offset against the personal assets or cannot offset against any other asset group. Only he can offset, or that client can offset under the collectible group. I will give you example in a minute and you can understand this one, right? Second one, if you make it any loss from your personal use asset, your dining table, your wall hanger, your chairs and tables and beds and anything, electrical appliance you use in your home, if you make it loss, that will be disregarded. You cannot carry forward, you cannot offset again any other assets, it will be fully disregarded, right? The loss on the collectible can only apply the gain from collectible. That's the one I already explained to you guys. Now I will explain this one through a example. All right. So current income year, taxpayer had collectible capital gain $300. He has $300 collectible capital gain. And capital loss from the collectible, so assume that first one with the one group jewelry, he make it $300 capital gain. From the painting, he lost that, how much the collectible, $500 loss, right? And in the same year he make it some capital gain from the shares, $600, right? So we have three transaction. Collectible, he got some capital gain, assume that that's a jewelry, $300, but he lost that collectible from $500 in the same year. That's come from, say, painting. He lost that in the painting. And $600 capital gain he gained from shares. So three different transactions. One gain from collectible, one loss from collectible, one gain from other group asset like a shares. Now we want to see how much capital gain we are going to include in our calculation. So when we look into this one, so what we learn, collectible losses only offset the gains collectible. So how much the collectible loss? $500. They can offset only against the $300. So 500 loss, 300 gain. So the net collectible or collectible capital gain now $200. Sorry, collectible capital loss now $200 because $500 loss, $300 gain. So difference between two, that's in our collectible loss. Everybody happy with that? Now, still we have other $600 gain from the shares. Unfortunately, you cannot reduce your capital gain to using the collectible to shares. Therefore, what is your final transaction in your capital gain? The $200 collectible loss will be carry forward for future years if you're making the gain from the collectible to offset, and 600 you are going to include in your assessable income and pay that capital gain included in the assessable income and pay the tax on that, right? So your net capital gain will be 600. Capital loss from collectible cannot be reduced the net capital gain to 400, but must be carry forward. Everybody understand? We cannot say, hey, 600 gain here, 200 from collectible, I want to offset this also. No, we cannot offset because the rule is that collectible only can offset the gain collectible, right? And the personal use assets, if you make it loss, disregarded. You cannot do anywhere, that's gone. If you make it gain from the personal use assets, you're going to add with the assessable income. That's called collectible rules on that capital loss. Personal assets disregarded. I put the summary of this one for you to understand later. The collectible capital loss only can offset a gain. Collectible capital gain can carry forward to future years. Capital gain exemption for the collectible. If you purchase any item less than $500, you no need to pay that capital gain, or you no need to calculate the capital gain. The personal use asset, if you can't offset the gain, the personal use asset capital gain can't carry forward. It's mean that disregarded. The capital loss will be disregarded. The capital gain exemption exempt any personal use asset purchased for less than $10,000. You no need to pay the capital gain. So anything purchased, not the sales price. Other assets, as we said, all normal rule, what we learn here, and general exemption. There are a number of general exemption we learn. Main house residence, in your CGT asset, like before 20th of September 1985, all that exemption assets will be applicable to other assets, right? So now we will move into CGT event, right? CGT event. Right, now we are going to talk about the timing of CGT event. When exactly taxpayer liable to pay their capital gain tax or capital gain, when exactly liable. That's called CGT event, right? There are two very simple terminology we're going to talk here. One, the when contract for the disposal is entered, that's the day CGT event, right? When contract for the disposal entered, that's the day that client liable to pay that capital gain tax, right? The day he signed the contract, or the ownership stopped, or you transfer the ownership to other party, whichever first we normally consider it as a CGT event. If your contract signed, no matter it's settled or not, it's like in your accounting accrual basis system, right? Contract is signed, that's the day or that's the time going to be considered as a CGT event. If there's no contract, what is the day in your asset ownership transfer to other person, or your rights and obligation of the assets go to other person, that's the day your CGT event if there's no contract. So whichever first, right? So we will give you one example to understand this one. A taxpayer entered into the contract sell this investment property 30th of June 2019. However, you may remember that settlement may be different date after 14 days or 20 days or 30 days or 45 days. That's depend on the state legislations. That's called cooling off period. So assume that here 14th of July, that's the settlement period. So what is the timing of the event here? So we want to prepare the tax return in our 1819 tax return, or we can do that in 1920 because that's actual money you receive 14th of July, right? So what we learned from that is just above, the timing of the event is the date contract is signed. So no matter what the date of settlement, therefore 30th of June, that's the day we going to consider as a capital gain event. We want to calculate that capital gain for 30th of June 2019 tax year, which is 1819 financial year. So you calculate and pay the tax on that. But actually settlement happened in the next year. So you may ask what happened if the settlement not happen. You can do that amendment and get the back money to the client. In real world, what we do, we even though that's for the 1819 financial year transaction, we will leave it until 14th of July. The settlement occurs, then we will prepare the tax return for 1819, right? However, if you prepared and lodged for 1819, but the contract is cancelled due to the finance approval or due to that any other reason, um, you can amend the tax return and say that particular capital event is not incur or not occurred. So that's called timing of the event. So time of the contracts enter into, capital gain will be included in 1819 tax return. Now, how are we going to work it out? The capital gain equal to capital gain proceed minus cost base. Your capital loss will be, we use the word reduced cost base. Reduced cost base mean you can see capital proceed in the other side because of the minus number. We always call capital loss is as a positive number, but we calculate cost minus proceed, right? So now we should understand what is the capital proceeds. We talk about very clearly money you received or entitled to received. A couple of slides before we talk about the Juliet and Romeo's case, like a gift that's entitled to received. He gave the free, that's not a matter. What is the amount in the entitlement? Market value. So that should be included as a capital proceeds, right? And when you register for GST, the GST component should be excluded from your capital proceeds, because as we discussed previously, GST belongs to ATO. We just collecting and sending to the ATO. Therefore, any GST component in your sales can be excluded from your capital proceeds. All right. Market value substitution rule, we very clearly talk about under the Juliet and Romeo's that gift. So whatever that transaction happened, you sometime people signing the contract with the undervalue. For example, $5 million property. If they sign the contract for 2 million, tax office can come back and ask, hey, the market value is 5 million, so I'm going to consider that property sales even though you signed 2 million as a 5 million. That's called market values. The day the transaction, what is the market value, that going to be considered as a capital proceeds, right? We cannot exclude. That's what is the contract amount, it's not material if it is a significantly varied. So that's the one we talk about under the Julia and Romeo's example. And even if somebody, if they want to avoid that capital gain and do that something lower, undervalued transaction, that ATO may come back with the audit and ask them to come with that market valuation for the date of sale. Then you must do that amendment for the tax return. So anybody not doing these days that type of transactions. Now we will move into work over the capital gain cost base. There are 5 elements as I indicated initially, not only that purchase price of that capital assets, there are other 5 elements as well. First one, what's the money you paid or property given to the CGT assets? That's be acquire assets or disposing assets. Whatever asset you purchase price, that should be included. Any incidental cost, when you purchase that asset, you are paying the remunerations, surveyor fees, auctioneers, accountant, broker, consultation, legal advisors, all this stuff you are paying, that can be included as a cost base. And cost of the transfer, stamp duty, any similar duty, cost of advertising or marketing can be included. Cost of owing CGT asset, your land tax and repairs and maintenance and insurance. This can be come under the cost of owing CGT assets, that can be included. And but don't include if you acquire assets before 21st of August 1991, if acquired, and if you have climbed deduction for any of the income years, you cannot claim. So simple is that if you already climbed these expenses, you cannot add with the cost base because no double deductions, right? If you acquired assets before 21st of August 1991, you cannot include that in the cost base. Capital cost include increase that the improvement, you maybe did some improvement in your property, like extension of the kitchen or the land filling of the land or whatever the improvement or you made, that can be considered going to be included in your cost base. And last one, that capital cost preserving or defending your title or the rights. What's the meaning? For an example, legal cost. If you not claimed previously, you can include in your capital cost. So there are 5 elements. So money what you paid and incidental cost and cost of owing CGT assets and your improvement as well as preserving your assets. So 1 to 5. If you claim anything 2 or 3 or 5, you cannot claim again because that's no double deduction allowed. There are special rule if your assets purchase after 13th of May 1997. What's the rule? The cost base does not include 145 element if the taxpayer have claimed the tax deduction, right? 145 if we climb the tax deductions, right? The reduced cost base rental property capital works deduction previously allowed, right? So we will talk about this topic. I'm going to explain the last point through example how with the capital work deduction happen, how we going to treat that one. So at this point, what you want to say? There are 5 elements in the cost base, and if I deducted previously any cost of owing assets, so capital sorry, legal cost, you cannot claim again, right? And your reduced cost base, whenever we do that capital loss, with that you'll use the terminology reduced cost base. So 1, 2, 3, 4, 5 same, but we cannot include in our cost of managing owing assets like land tax and others cannot be included here. Instead of that, it's going to be a balancing adjustment amount. That's only number 3. That's the two different between reduced cost base and cost base. CGT discount method. All right. Right. Now we were going to come and talk about that some discount method and indexation and other method what we talked previously. I'm sure you guys can see that now our XPM. So one a simple example, 10,000, how much? $10,000 in your yep, $20,000 you purchase. I will change this one. Your cost is 5,000 for an example, right? So how much that your capital gain? $15,000. This is the one in our income section. It's going as a income, and you can see here taxable income $15,000. Now we will do little magic. Click that in the discount. Yes, it's come down to 7,500. How that happened? Now we want to see how that is happened. Capital gain still remain as a $15,000. However, you can see some 50% take it out, right? The discount method mean it is take it out some, you waived off some capital gain. So 15,000 in our capital gain, in our net capital gain, only 7,500, which is you can see as a taxable income. So when we are going to click that discount method, so if you click other method, 15,000. If you click indexation, it's showing something different, but I will explain to you within a couple of slides later. But when you click the discount, it's going to see 7,500. So you have 3 options to click here and make it this number different. Right now we will see how when you going to click the discount, when you're going to click other, when you are going to select that indexation, how that's work, right? That's called in our tax relief from the capital gain, right? But when you click the other, same amount, your capital gain 15,000 equal to net capital gain also 15,000, right? I will go back to now my slides. Everybody can see the slides, right? So the discount method, this is the one we talk about over there. So who is eligible to discount method? Eligibility, asset should be hold more than 12 months. What's the meaning? Your purchase price and sales price should be more than 365 days. In that case, you can use this method. So what are the eligibility criteria? Asset should be withheld more than 12 months. This means your purchase date and sales date should be different between two, should be more than 365 days, right? If you satisfy that condition, we can click on the discount method for Australian residents only. You cannot apply the discount method for non-residents and companies. Only you can apply for Australian resident and super funds. How much the discount for the individual like you and me, Australian residents? 50% discount. That's why $15,000 capital gain divide half 50% off income as a 7,500, right? So Australian resident will be 50% exempted all their capital gain. If they hold that assets more than 12 months, that's the eligibility criteria. If a super fund, this discount will be 33.33%. It's mean one third of, for example, $90 your capital gain, you will be discounted $30, after that 60. But if you are an individual, your capital gain $90, you can be reduced 50%, which is $45. Your capital gain will be $45. Right? So that's the way this particular discount method works. So who can use that discount method? Whoever Australian resident who hold that property more than 12 months, or super fund hold the property more than 12 months. That's very important. Eligibility criteria will be 12 months or more, right? Good. Now we will see some example. Rachel, he bought the property for $7,000 and sold the shares for 10,000. So calculate the Rachel capital gain. So what we will do, capital proceed 10,000, loss cost base 7,000. So capital gain now $3,000. We ask the Rachel, are you an Australian resident? Rachel says yes. And how long you hold the property? 2008 to 30th of June 2019. Very clear here, more than 12 months. Therefore, we can apply discount of 50%. Now your net capital gain will be 1,500. For an example, if Rachel purchased this property 27th of April 2019, we cannot apply her because that's less than 12 months. But this example, 27th of April 2018, therefore more than 12 months, we can apply capital gain 50%. So net capital gain will be 1,500. So that's example one. So Rachel will be 50%. The general discount must be after all and current prior tax losses deducted. So what's the meaning? If you have some losses, you want to carry forward from the previous years, you want to settle first before applying capital gain. So we will see one example. Tim, so how much that's Tim acquired shares in July 2000 for $10,000 and sold it 2018 50,000. So more than 12 months. So how much the capital gain? 50 minus 10, $40,000. Where he's coming from this gain? From the shares. Now second part, how much? What? Oh yes. So Tim, he have the loss this year from shares 3,000 from other company, XY Limited company. So his gain from ABC Limited 40,000 and XYZ Limited, he lost that 3,000. So 40 minus 3, now he have 37,000 capital gain. Again, Tim has carry forward loss from the previous year loss come to here 6,000. So his gain from XY Limited 40,000. Sorry, ABC Limited gain 40,000, XY Limited 3,000, previous year loss 6,000. So total loss for him 6 plus 3, $9,000. Total that gain 40,000, right? So 40,000 minus 9,000, 31,000. And you are going to apply the discount on 31,000, which is 15,500, right? The loss which should be taken out before applying discount. So very clear, the first line, general discount only available after taking out all the losses, right? So 40,000 minus all of your losses, 31,000, and less 50% discount you are going to apply. Now that your net capital gain will be 15,500. Very simple, right? So very important in this one, we cannot apply 50% discount straight away from 40 if you have the loss. Loss should be offset, then balance 31,000, you are going to apply 50%. But when you're doing this one from your XPM, is automatically calculate. So you know when you click the discount, it's automatically take it out the loss, then only it's calculated 50%. All right. That's a CGT discount method. So there are different scenarios. I am going to put here one other scenario. Zoro is assumed that he's Australian resident. He purchased a land. Most of that middle income earners, what they do, they purchase a land and subdivide into two and living in the one side and sold it the other side or something like that. So he also, Zoro also same. He acquired a block of land in May 1997 for $200,000. He subdivided into the two blocks equal size in January 2017 at a cost of $3,000 subdivision cost. And 1st of September 2018, Zora sold one block of land for $250,000. Another block he not sold, but market value is 150. That's different reasons, right? Even though equal size, maybe corner block, or maybe not as the right size or right, uh, the streets and etc. There's a different reason the price will be different, not only that equal size, right? So how much that they sold one property? 250,000. What is the other part of that market value? 150,000. Now they're coming to you to do the tax return. When you do the tax return, how we going to calculate actual capital gain for the block what they sold, right? Because when they bought it, the block, the 200,000, they bought it the whole size, right? That only that question here in our purchase price of the land for that what we sold, how much we going to include, right? Even though equal size, we are not going to divide by two and say my cost is 100,000. We are not going to say like that. So there, so apportionment method, we will see how it's going to work. The apportionment method mean what is the market value you sold that property, based on that you calculate the land cost, right? I put it a formula, but I explained through the number. How much we sold this property? $250,000. How much that land cost for that one? So what is the formula? Your cost base, which is $200,000. Your disposal consideration, it's mean money you received from the sales, $250,000, and divide by disposal consideration, $250,000 you received. How much the market value of the part of the property not sold? 150,000. So it's 250 plus 150, 400, and about 200 times 250, 125,000, your cost base. So how we calculate this one? Based on the market, based on the value of the property, what is the cost for that particular land portion. So 125,000 in our land cost, and subdivision will be normally equally divided. 3,000 divided by 2, 1,500, and you have selling cost $5,000. So your total cost base now 125, 1,500, and $5,000. And if you take it out, capital gain 250 minus all of that, 118,500. Can we apply to that discount here? Yes, because Sora is holding that assets more than 12 months. You can say May 1997 and sold it for September 2018. So therefore more than 12 months, and Sora is an Australian resident. Therefore we can apply 50% discount. Now sees her net capital gain will be $59,250, right? So this is the way we're going to calculate if it is some subdivision and etc. Then we will move into uh, one of the area I said that I will explain later, especially capital work deductions. This is especially involved with the investment property. The investment property, there are, when you do that rental schedule or rental income, there are two type of depreciation you deduct. One for your building, that's called capital work deduction. Other one for your fixtures and fitting, which is the asset depreciation. But we are not going to be, we are doing some adjustment for the asset purchase, but for the capital work deductions, what we do, we're going to take it out from your cost base, right? So what we're going to do, we are going to check that in the previous tax return, if they deducted any capital work deduction total capital work deduction should be take it out from your purchase price. It's mean your cost base will be come down. If the cost base down mean client will not happy. Why? They are going to pay more capital gain. However, this capital work deductions already deducted from that your previous income tax return. That's the reason we are going to reduce from your cost base, because we should not allow the double deductions. What is that? What happened to that other type of asset depreciation? We are not going to take it out the cost base. We are going to adjust that one to depend on that what the balance of the asset depreciation, right? So there's an adjustment required. When we do a tax return later, we will explain to you clearly how we do that one. But the simple answer at this point, capital work deduction for your building deductions, you want to reduce from your purchase price to make it the cost base right. Otherwise you are going to do the two times capital work deductions. Capital asset deduction, what's going to happen, we're going to do a adjustment based on the balance of that particular depreciation assets. So like you have air conditioned machine, you have a washing machine, you may have a cooking top and everything. We're going to do a separate adjustment when we do that capital gain. So at this stage, the simple answer is capital work deduction completely. You take it out the purchase price, but you are not going to take out that asset work deduction at this stage. So 375, he sold that. Cost base will be now not 300,000, 262, because that 37,500 you already climbed, and capital gain will be now 112,500, right? So capital work deductions, I will cover this capital work deduction under the rental property income later, right down the track. 50% discount for wallet, assume that is Australian resident. So you get more than 12 months, therefore 56,250 in your net capital gain. Now we'll come to that very interesting topic, frozen indexation method. So I use this indexation method in other classes as well, other my teaching, but the last time when I started to teach, I completely forgot about that frozen indexation. One of the students, I think Peng, he helped me to that quickly to recognize that one. Thank you, Peng. So frozen indexation method. So is a second method. So we have discount method and indexation method and other method. So now we are going to talk about the frozen indexation method. Who can use the frozen indexation method? You should have more than 12 months you have assets, plus this should be purchased before 11:45 a.m. But the time I think that Canberra that legislation passed 21st of September 1999. To use the indexation method, you must satisfy two conditions. Condition number one, asset should be purchased before 21st September 1999, right? Asset should be acquired or purchased before 21st September 1999. Second condition, you must hold that assets more than 12 months. You purchase and hold more than 12 months. If you satisfy these both conditions, you can use the indexation method, right? So who can use? Company or non-resident or non-resident, everyone can use that indexation method, right? So what does that indexation method do? You know that your purchasing price of the money 10 years before 10,000 not equal now 10,000, right? 10 years before you can buy a lot of things with the $10,000. Now you cannot. So you can buy a lot of things, but actually your purchasing power down. So you accommodate that purchasing power in your calculation. It's called for indexation methods. Allow to the increase the cost base by applying an indexation factor. So how we going to do the indexation factor? We will see in a minute with that example I will explain, right? Indexation method cannot be applied for capital loss situation. This means if you make it capital loss, you cannot say I'm doing the indexation method and make it capital loss, right? Now we will move into how we're going to do. I am going to explain through example. Louis acquired a rental property 5th of July 1997 for $100,000 and she sold the property for 15 February 2019 for 250,000. Yes, he make a lot of money, right? So if you want to use the frozen indexation method, what exactly we want to do? Two criteria. Number one, when it is purchased before 21st of September 1999, yes, 5th of July 1997, before that date. So first criteria is tick, yes. Second one, you must hold the assets more than 12 months. How long she hold here? To 1997 she bought it and sell it for 2019. So more than 2.5 years. So very straightforward. We can say um, say hold it more than 12 months. So both conditions are satisfied, then we can use the indexation method. So I said that previously, to use the indexation method, you want to multiple your cost base 100,000 by a indexation factor, right? So don't worry about the indexation factor. I will explain within a couple of minutes later. So assume that your indexation factor for this example 1.032. I will explain to you in a couple of minutes later how you got this number, right? So yeah, we got it the number now 1.032. So how we going to calculate? So your cost base will be increased. Your cost base will be 100,000. That's your purchase price times your indexation factor 1.032, which is 103,200 now. No more 100,000. If you're using the indexation method, your cost base will be goes up, right? Now we will see how much your capital gain. So capital proceed $250,000. Capital index cost base 103,200. Difference between two 146,800. You can see I use the terminology net capital gain. What's the meaning? You cannot use the discount for this 146 because if you use the indexation method, you should live with the indexation method. You cannot apply 50% off from this one, right? So that's a discount method. That's a different method. So if you use the indexation method, your net capital gain will be 146,800. You're going to include with the assessable income and pay the tax. Now, so which method you prefer? Indexation method or discount method? Because Louis satisfy the discount method as well. You can see she is holding more than 12 months. She is Australian resident. Therefore, she can use the discount method also. Right. So if you are a Louis is Australian resident, which method you will prefer? Most probably a discount method. Why? Discount method, how much that her capital gain? 250,000 proceed minus 100,000 cost, 150,000 capital gain, 50% you applied, so 37, sorry, 250 minus 100, 150,000, 50% you applied the discount, so 75,000. You see your click, how big different in your tax return. If you're doing through the discount method, if you calculate 75,000 your capital gain. If you're using the indexation method, 146,000, very expensive. Therefore, when you are doing the tax return, you're going to do both together, right? You're going to do the indexation method, going to do the discount method, and see which one going to give you less capital gain. That's the one you're going to include, right? If you're doing this method, you may save to that your client around $16,000. One click will be make it big difference, right? Good. So how we going to get it, this indexation factor? That's the one I want to explain to you guys, right? If you go back to that your consumer price index, I will share the screen, right? So this one you can see your CPI rate, right? I'm sure that you guys are in. So if you go down, indexation, that as I said, this index, we are using several different calculations. That's why all the numbers are here. So what we did that for Louis case, if you refer that Louis case, 5th of January that 1997. You can see this one every quarter, the end of 30 March, 30th, 1st of March, end of 30th of June, end of 30th of September, end of 31st of December. So everything come up like this. Now, indexation factor. So it will be here the number, that's the CPI. So we will see. So when Louis purchased the rental property, 5th of July 1997. So you go straight away down to the 1997, 5th of July, the third quarter, because that's the September quarter, right? The 5th of July come under this up to September, right? So if you go to the 1997, 66.6, right? We got it, right? Now we will come back to 15th of February 2019, right? 15th of February 2019 will be this number. But if you go and see in your PowerPoint slides, I include only 68.7. Why it is? It is frozen for capital gain calculation. This is the one I missed in my class. But because normally we use this indexation in that other calculation, I straight away went and said 114.1. I think Pink said that no, Shan, it is frozen in 1999. So what is the 1999 very special? So for capital gain indexation, it is not same as other indexations. It is frozen at 1999 September. Any date after this date, you want to go and say no, 68.7. That's called frozen indexation rate, right? So 66.6, that's come from 5th of July 1997. 5th of February 2019, even though 114.1, we cannot use 114.1 because the method say if anything after 21st of September 1999, it will be frozen in this date. So whatever date after this, so whenever you do that now, your sales always 68.7, right? So that's called frozen index at 21st of September 1999. So 68.7 divided by 66.66, 1.032. That's the way we got that number. So now we will come back to here. So this is the one I explained, right? So that's 68.7 come from 99 September quarter, right? So when you do that exercise, there are a number of homeworks. You will familiar with this number, how you're going to do this one. Now, move into that, how we going to do this one through that in our XPM. I will explain through the next example, right? So example here, Jamie acquired a building $60,000 on 1988, and she did some kitchen extension, that's called improvement, in August 1993 for $25,000. And 31st of March 2019, she sold the property for $140,000 and selling cost $6,000. Now we want to calculate the capital gain, right? How much the capital proceeds? Very simple. So if you use the indexation method, we must calculate the indexation factor, right? So there are two indexation factor here. One, 1st of July in 88, the purchase property $60,000, and second indexation factor 1993 August 25,000, right? So we will see both factor first. Indexation factor for the building. So what is the date purchase? 1988 July. If you go and see in your CPI table, let's say 68.7. Where you got the table? So I will show you again. If you go to that, you click here in this link, consumer price CPI indexing link, it will be open same as what we saw that big table, right? So now we will go back to building. So what's the date we purchased? 1st of July 88. So which is, if you go to that table, 50.2. And when we sold it, 2019, after 1999 September, therefore same number, 68.7 is frozen. And second one Improvement. What's the date we purchased? 1993. So 1993 August, what is the number? 61.1 in the table. But it is sold after 1999 September, therefore 68.7 is frozen. So if you calculate these two, one is a 1.369, other one 1.124, that's the indexation factor. Then you're going to calculate the capital proceed, $140,000. That's coming from straight away how much they sold. So now your cost base 60,000 times 1.36 for the 1.369, right? Another one for that 25,000, 1.124, and your selling cost $6,000, and your capital gain will be 23,760. For this one, which method you will prefer? That indexation method or discount method? How much indexation method give us the capital gain? 23,760. If we use that discount method, how much the discount method? 140,000 capital proceeds, and your cost base 60 plus 25 plus 6, which is 91,000. 140 minus 91, which is your capital gain, $49,000. If you applied 50 percentage, 24,500. So if you use the discount method, 24,500. If you use that indexation method, 23,760. So better to use here indexation method, not like last time, right? Therefore, you understand here, sometime indexation method will give a better outcome than discount method as well, right? We will go now, share with that in our XPM and see this example how we going to do, right? So you select that indexation method, how much that the purchase price, that how much that sales, 140, right? $140,000. You click here indexation. So what is the first cost? First cost is $60,000. How much your indexation factor? You calculated 1.369. What is the second one? $25,000. What is the indexation factor? 1.124. So you want to go and see how that is work, right? 1.124. That's right. We calculated. And how much is selling cost? $6,000. This is after 1999. Therefore, number one, automatically one, right? Good. So we calculated. You see 23,760. This is the one we did that through the in our PowerPoint, right? Now it's showing here same amount. If you have the copy of the PowerPoint, you can see 23,760. So you are going to your taxable income will be 23,760. All right, I'm going to change this one to the discount method. Click on the discount. We want to change that in our cost now. Where's the cost base? So how much the cost? We said that 60,000. Right. Other one 25,000. Sorry. No, one more zero more. And other one $6,000. This is the cost, right? Good. You can see now you are paying more tax, 24,500. So you go now indexation. If you click indexation, 23,760. Once you entered, you no need to change, right? Discount 24,500. So better do I click that indexation and pay less tax. This is called indexation versus discount method, right? One more example. I will go and we will share with that in our PowerPoint back. The frozen indexation method cannot be used to produce capital loss. That's the one we talked about previously. Example here, Andrew purchases shares for $25,000 and he sold it for $28,000. He make it $3,000 profit. He's very happy. So how much that discount method capital gain? 28 minus 25,500. Sorry, $3,000, 50% off. So he going to include 1,500 as a capital gain for the discount method. But if you're using that indexation method, how does that work? You want to calculate the indexation factor. What is the purchase date? 31st of December 1992, which is 60.1. And this is sold now, always 68.7, right? So divide that one, 1.143. So your cost base will be 20 with the 5,000 times 1.143. How much it is? 28,575. So how much the capital proceed? 28,000. How much the index cost base? 28,575. So here loss, right? So in that case, if you make it loss, you cannot make it the loss using the indexation method. Very clear here. So they are saying you cannot make that capital loss using the indexation, but you can make it zero, right? Capital gain, zero. You are saying I'm going to use the indexation method, but I'm not going to make the loss. That's fine. I calculated my capital gain will be zero. That possible. That's called the cost base cannot be index. Extend that index, create the capital loss. Why I am doing like this? If I go and click the discount method, I am going to pay $1,500 worth of income tax. But if I using the indexation method and make it capital gain zero, you don't need to pay any cents, right? Therefore, you must understand sometimes people not applying this rule properly, right? So when it is come to that indexation method, you can make it capital gain zero, but you cannot say I have a loss of $575, right? You can make it capital gain zero, click the indexation method, indexation, even though coming the 575 loss, you're going to make it zero, but software will be work with that one, so you no need to worry this zero. If you click the indexation and put this all the numbers, that capital gain will be zero, right? That's not making the loss from the indexation method. So you can practice when you have the time at home. And so which method we prefer here? We prefer to go with the indexation method. If you're going with the discount method, we may be going to pay that capital gain for 1,500. Right, the part disposal that as I explained previously, the same rule will applicable here. You're going to calculate the indexation factor 1.027 multiple by 200, which is 205,400. Now capital proceed 250 and index apportionment cost, you're going to calculate based on the revenue, that income 128,375, and subdivision and land selling cost same 125,21 net capital gain. So how what we are doing here? So last time your land cost 200,000. This time your land cost 205,400. Rest of the calculations are same, right? Nothing changed. So only what you are doing. So your index apportionment of the cost, right? The previously you did the land cost 200,000. Now you are going to do the land cost 205. So rest of the calculation same as what I explained in your previous example under the discount method. So you now your land cost will be indexed 205. The same apportionment rule, 400,000 your total value of the land, 250 sold, 150 is market value. So your land cost now 205,400, your sales price 250. So your land apportionment cost base is 128,375, 1,500 and $5,000. Your net capital gain will be 121,875. Most probably you may be prefer to use that discount method for this example. Other method, when we are going to use the other method, so we talk about the eligibility. If you buying and selling within 12 months, you cannot use that discount method or index method. You can use only other method. What's the meaning? It will be a same as capital gain equal to net capital gain, other method, right? So if you are less than 12 months, we're going to use the other method. Or asset purchase after 21st of September 1999 by companies or non-residents. They fall under this category. They're going to use that other method. So other method, if the assets held less than 12 months, this is the method. Or companies and non-residents who purchase the assets after 21st of September 1999, they cannot use the indexation method. They are not eligible to discount method. So their only option for them, other method. So first criteria is a less than 12 months, always other method. But for the companies and non-residents, if they purchase the assets after 21st of September 1999, their option is only other method, right? So you can say purchase a land, $60,000, 15 September 2008, and sold it to March 2019. You can see very clearly less than 12 months. Therefore, Ben's net capital gain will be capital proceed minus capital loss, $40,000. You can see I use the terminology net capital gain because you cannot apply the indexation. You cannot apply the discount method because this asset is purchased and sold within 12 months time. If you buy and selling within 12 months time, you cannot get it the discount, right? Other method, Kathy acquired the shares 27 September 2018 for sold 7,000 30th of June 2019. You can very clearly say less than 12 months. So only the net capital gain is $3,000, right? So you must keep that all the records when you do the capital gain, which is very important for substantiation purpose. We're going to talk about that, what kind of evidence you required when we talk about the substantiation. However, all the capital proceeds, all the cost base, and all of your transactions will be substantiated. It means you should have evidence, your purchase receipts or settlement statement or contract of land or whatever. You must prove that this is my purchase price, this is the amount I received, this is the expense I made. All the things should be substantiated to prepare the capital gain. Now, main house exemptions, as I said previously, in your main house will be exempted. That may be a house, that may be a flat, that may be a motorhome, that may be a caravan, houseboat, everything going to be considered. If you are ordinary meaning of the word, if you are living in that particular property, that can be considered as a main house. When you're selling your living place, that going to be exempted from the income tax. It means you no need to pay the capital gain tax, and you no need to calculate the capital gain tax in your income tax return, right? The land will be maximum 2 hectares. Special word, adjacent, which means adjoined land, right? The the main house exemption. So when we determine this is your main house or not, it means you are living or not. They will ask a couple of questions: how long you are living, where's your family, what is your mailing address, what is the intention you are occupying over there, where's your electoral roll address, what is your personal belonging. All these question will be asked in the case law to determine your main house. But the normal rules, somebody living in a house, the ordinary meaning of the word, right? It's mean any person look into that, they are living in that house, that's going to be their main house residence, right? That's the way it's worked. There are exemptions for the 6 years. For example, you are living in a house, just you move out from the house and you're renting out somewhere, but that 6 years rule will work. What's the meaning? You are in your main house is here, you move into that in a other house and rent it house, you are in a rental property, you can rent it out this property up to 5 years, up to 5 years, sorry, up to 6 years, my apology, up to 6 years. So if you sell it this property within 6 years, you will be exempted from capital gain, right? That at the same time, only you can get in one main house exemption. I think that somebody asked this question in the class. So if you are living in a other rental property or wherever, so this house will be maximum give it to you 6 years, right? You living in a main house and you move out from the house and living in a other rental property or wherever, and this house will be exempted for if you rent it out for maximum of 6 years. For example, if you rent it out for 5 years and you are selling that your main house, now it is exempted one. So after 5 years, you after 6 years, before 6 years, you come back and living in this house other 1 year, again go back out from this, that 6 years rule always work, right? Now the important question, as I said, that you cannot have two main house resident exemption in the same time. Two main house exemption same time you cannot have. What I'm saying, for example, you have a house here, your main house, you rent it out, and you move and purchase a other house, mean now your main house will be the new house. The previous house, date of you sold, normally considered as a not going to be exempted for the 6 years. However, there will be a 6 month transitional period. Within the 6 month, if you sold it and settled, you will be get the full exemption for that previous main house, right? So that you is still going to get the exemption for the house, but that within the 6 month of your new property if you purchase. I think this will be clear, this one. So the taxpayer entitled to another maximum period of 6 years each time dwelling again become and cease to be main residence. What's the meaning? You can come back and stay and go again, that will be less than 6 years, is fine. So there are two important points here. Same time, you cannot have two main residence exemption. Only one you can have. For an example, you living in a main house and go out from here. If you purchase a other main house in the same time, in your 6 years rule will be the previous house will be not going to be considered as a main house. However, if you sold that property within 6 months of your new house purchase, that will be exempted as a main house residence. All right. I think now it's clear. If it is not, I will explain to you guys in the next class. Identify the dwelling is not used to produce the assessable income. For example, you purchase a house and you live in that house, you move out from the other country, but you're not putting anything for the rental or any other income from that property. Anytime when you come back, when you sell it, that can be considered as a main house. You no need to pay that capital gain. I put that capital gain tax property exemption tool, which is provided by ATO down for you to have a play with that one. Right, main house exemption. Jose occupied the house, his main residence, for 4 years. He was transferred in his employment overseas for 5 years and rented out the house during this time. He returned home after 5 years, reoccupied the house. Required determine whether main exemption will apply. Jose had no other main residence while overseas. He can choose to treat the house as the main residence during his absence. What's the meaning? If he sold it that house, even though 5 years he rent it out, he will be get that full exemption. The main resident and exemption does not apply. Any future disposal of the house exempt from capital gain tax. The main resident exemption does not apply, and any future disposal of the house is exempt from capital gain tax. So John occupied the house of his main residence for 3 years. All right, so this is the same thing. Right, so Sachin purchased the house 1st of July 2016 for $500,000. He occupied in the house main residence, but used 1/5 of the place as a business. Sometime in our main house, we partly rent that on a couple of rooms. You may be rented to other party, or you may be rented out your granny flats. But when you sell it, that one, how does that work? Based normally we use that floor area. Based on the floor area, wherever you live, it's going to be considered as a tax free. But wherever you rent it out, like a granny flat, that's going to be considered as a business. You're going to pay that capital gain tax on that. So that's the example we are explaining here. So $800,000, they sold it. What is the price they purchased? 500,000. So capital gain will be 300,000. So what is the proportion? See, rent it out 1/5. How many years he rent it out? 4 years he live, only 3 years he'll that rent it out. So 3 divided by 4, that's the proportion of that particular period. And how much he rent it out? Only 1/5. So 45,000 going to be a capital gain. Sachin assumed that he's going to be a resident for the tax purpose. So 50% will be discounted. So 22,500 is net capital gain, right? So what exactly we learned from here? If you rent it out a property, partly you are going to calculate that part. What is the capital gain? Right. Foreign residents, this is important. Temporary resident and foreign residents are not required to report their abroad property capital gain. However, they are required to put that capital gain on any assets purchased in Australia, right? Made capital gain after 12th of December 2006. There's a special rule. If you purchase a property in Australia and sell it, no matter you are resident, you are a non-resident or temporary resident, you're required to report the capital gain. Non-resident not entitled to the 50% discount after 8th of May 2012, long time ago, right? So when you prepare now, it's not going to be, they are not discounted. Become Australian resident. So assume that a person just come to Australia and he is a Australian resident for the tax purpose. How does the capital gains tax work? The day they become an Australian resident, that's the day they are liable for all the capital gain from Australia and outside of Australia. So how we going to understand this one? So for an example, a person moving to here as a skilled migrant, now he got that Australian residency for the tax purpose. So assume that he got that Australian residency 1st of January 2020, right? Now he's selling a house, which is, if you like, please note down, that's easy to understand. So he sold it for $500,000, right? When he sold it, 30th of June 2020. So how much he sold it? For $500,000. The house he purchased in 1st of January 1990 for $100,000, right? How much the capital gain, right? So when we calculate the capital gain, there are 3 dates important here. What is the date he purchased? 1st of January 1999. What is the day he's going to become Australian resident? 1st of January 2020. What is the day he sold the property? 30th of June 2020 for 500,000, right? So when we calculate that capital gain, we are ignoring what the cost base, what the date he purchased. We're going to see what is the value of the property when he get the Australian residency. When he got the Australian residency, 1st of January 2020. So the client should go and ask from the valuer in that country and get the valuation. Assume that 1st of January 2020, they valued the property $490,000. Now, how much the capital gain? Capital gain will be capital proceed $500,000 and capital cost or cost base 490. So that $10,000 is capital gain. He's a resident for the tax purpose, applying 50%. So $5,000 discount. So he's going to include that capital gain only $5,000. He no need to pay that capital gain 500,000 minus his original cost price of 100,000, and he no need to worry about that 400,000 capital gain. So for becoming Australian resident mean date he become Australian resident, what is the value of the particular asset going to be considered for the cost base, right? That's the example we explained here. If you choose to be Australian resident, that's the day you see not Australian resident, your international properties going to be considered, that's the day you sold, right? Same as other way, right? Cease to be temporary residents, I explained through the becoming Australian residents, right? So we are going to finish today and looking forward to see you next week. Thank you, everyone.